Today, we're diving deep into a topic that influences every dollar you spend and invest: inflation. Specifically, we'll unpack the Consumer Price Index, CPI, the Personal Consumption Expenditures, PCE, and how the Federal Reserve uses these metrics to steer the economy. Understanding these can give you a significant edge in your investment decisions. Let's get started. Understanding inflation. Inflation refers to the rate at which the general level of prices for goods and services rises, eroding purchasing power. It's a natural part of a growing economy, but when it accelerates too quickly, it can lead to economic instability. To monitor and manage inflation, economists and policymakers rely on key indicators, primarily the CPI and PCE. Consumer Price Index, CPI. The Consumer Price Index, or CPI, is perhaps the most well-known measure of inflation. Published by the Bureau of Labor Statistics, it tracks the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. This includes categories like food, housing, apparel, transportation, and medical care. CPI is widely reported in the media and often influences cost of living adjustments for wages and benefits. Personal Consumption Expenditures, PCE. On the other hand, the Personal Consumption Expenditures Price Index, or PCE, is the Federal Reserve's preferred inflation gauge. Compiled by the Bureau of Economic Analysis, PCE covers a broader range of expenditures, including those not directly paid for by consumers, such as healthcare services covered by insurance. It also accounts for changes in consumer behavior, like substituting cheaper goods when prices rise, making it a more comprehensive measure of inflation. CPI versus PCE, key differences. While both CPI and PCE aim to measure inflation, they differ in scope and methodology. CPI uses a fixed basket of goods and services, which can overstate inflation if consumers shift their spending habits. PCE, however, adjusts its basket over time to reflect changes in consumer behavior, providing a more accurate picture of actual spending patterns. Additionally, PCE includes a wider array of expenditures and is generally less volatile than CPI. The Federal Reserve's role. The Federal Reserve, or the Fed, is tasked with promoting maximum employment and stable prices. To achieve this, it closely monitors inflation indicators, particularly the PCE. When inflation rises above the Fed's 2% target, it may increase interest rates to cool down the economy. Conversely, if inflation is too low, the Fed might lower rates to stimulate spending and investment. Recent developments and market impact. Recently, inflation has been a hot topic, with factors like supply chain disruptions and geopolitical tensions contributing to rising prices. The Fed's response has been to adjust monetary policy accordingly. For instance, in its May meeting, the Fed maintained interest rates but expressed concerns over persistent inflation and potential unemployment risks. Such decisions directly impact financial markets, influencing stock prices, bond yields, and currency values. What this means for investors. As an investor, understanding how CPI and PCE influence the Fed's decisions can help you anticipate market movements. For example, expectations of rising interest rates might lead to a shift from growth stocks to value stocks or increased demand for inflation-protected securities. Staying informed about inflation trends enables you to make more strategic investment choices. Inflation is more than just a buzzword. It's a critical factor that shapes economic policy and market dynamics. By grasping the nuances of CPI, PCE, and the Fed's role, you position yourself to navigate the financial landscape more effectively.